In Canada, corporate tax is a tax imposed on the profits of corporations. The federal corporate tax rate in Canada is currently 15% for general corporations, but certain small businesses can benefit from a lower tax rate of 9%. In addition to the federal tax, corporations in Canada may also be subject to provincial or territorial corporate taxes, which vary depending on the location. These rates can range from about 11% to 16%. It's worth noting that certain deductions and tax credits are available to corporations in order to reduce their taxable income. These include deductions for business expenses, capital cost allowances for depreciation of assets, and tax credits for specific activities, such as research and development. Taxable income calculation. In Canada, corporations are required to calculate their taxable income by subtracting eligible expenses, deductions, and tax credits from their total revenue. This includes costs related to running the business, such as salaries, rent, utilities, supplies, and interest expenses, among others. Tax filing and payment. Corporations in Canada are required to file their tax returns annually, typically within 6 months after the end of their fiscal year. The tax payment is due within 2 months after the fiscal year end. The Canadian government provides various methods for tax payment, including online options. Small Business Deduction (SBD). The Small Business Deduction is a tax benefit available to Canadian-controlled private corporations, CCPCs, that meet certain criteria. CCPCs can benefit from a reduced federal tax rate of 9% on their first $500,000 Canadian dollars of active business income. However, certain restrictions apply, such as limitations on the amount of passive income that can be earned. Provincial differences. As mentioned earlier, provincial and territorial tax rates can vary across Canada. Each province or territory sets its own corporate tax rates, and corporations need to consider these rates when determining their overall tax liability. Some provinces also offer additional tax credits or incentives to encourage business growth and investment. Tax planning and compliance. Given the complexity of corporate tax laws and regulations, many corporations in Canada seek the assistance of tax professionals to manage their tax planning and compliance. Tax planning involves structuring business operations in a tax-efficient manner by taking advantage of available deductions and credits. It is also important for corporations to maintain proper records and documentation to support their tax filings and claims. Transfer pricing. Corporations that have international operations need to be aware of transfer pricing rules in Canada. Transfer pricing refers to the pricing of goods, services, or intangibles transferred between related entities within the same corporate group. The Canada Revenue Agency (CRA) requires that transfer prices be set at arm's length, meaning they should be comparable to what would be charged between unrelated parties. This ensures that profits are appropriately allocated among jurisdictions and prevents profit shifting for tax purposes. Tax incentives. The Canadian government offers various tax incentives to promote economic growth and development in specific sectors or regions. These incentives may include tax credits, deductions, or exemptions. For example, there are tax credits available for scientific research and experimental development (SR&ED), investment in certain industries, film and media production, and clean energy projects, among others. These incentives can help corporations reduce their overall tax liability and encourage business investment and innovation. Compliance and audits. The Canada Revenue Agency (CRA) has the authority to audit corporations to ensure compliance with tax laws and regulations. It is important for corporations to maintain accurate and complete financial records and documentation to support their tax filings. In case of an audit, the CRA may request additional documentation and undertake a review of the corporation's tax position. It is recommended that corporations keep their records for at least 6 years to comply with the CRA's record-keeping requirements. Double taxation treaties. Canada has entered into double taxation treaties (DTTs) with numerous countries to prevent the double taxation of income earned by corporations with cross-border activities. These treaties generally provide rules for the allocation of taxing rights between countries, the elimination of double taxation, and cooperation between tax authorities. It is important for corporations to understand the provisions of these treaties, as they can impact how taxes are levied and the availability of certain tax benefits. Airzol is a leading provider of comprehensive tax solutions. With our team of experienced professionals and cutting-edge technology, we offer efficient and accurate tax services to individuals and businesses alike. From tax planning and preparation to IRS issue resolution, we handle all aspects of taxes with precision and expertise. Our commitment to delivering personalized solutions tailored to each client's unique needs sets us apart. Contact us today at +1 647 232 7909 and discover how Airzole can streamline your tax process and help you achieve your financial goals.